This digital ticker shows the pace of modern trading. Data changes by the millisecond, creating a constant stream of price fluctuations that make it difficult to identify where a stock is actually heading. Most retail traders have experienced the frustration of buying into a perceived breakout, only to see the price immediately reverse. This happens because large institutional players often build their positions quietly. By the time the retail crowd notices the price movement, the smart money has already finished its accumulation. Retail traders frequently get caught on the wrong side of these moves because they focus exclusively on price. However, price action on its own often hides the true intentions of the market's largest participants. This chart shows how a sudden price spike can occur on low volume. Without significant buying behind it, the move lacks staying power. It's a bull trap that lures in buyers right before the price collapses back to its starting point. Navigating the market requires looking past these price shifts. To understand which moves are sustainable, you have to track the underlying trading volume. Chaikin Money Flow, or CMF, was developed by Mark Chaikin to solve this problem. It acts as a filter, removing the noise of daily price movement to show the actual momentum of the money. The calculation is based on a 21-day volume-weighted average. It measures where a stock closes relative to its daily high and low range, providing a clearer view of buying and selling pressure. Visually, the indicator appears as an oscillator line moving around a central zero line. When the CMF moves into positive territory and crosses the plus 0.10 mark, it indicates buying pressure is the dominant force. Readings in this range show that institutions are accumulating shares. This accumulation provides the support needed for a sustained upward trend. If the indicator drops below the zero line and crosses negative 0.10, it suggests institutional support is fading and selling pressure is taking over. Monitoring this relationship with the zero line reveals whether the bulls or the bears are currently in control of the capital moving through the asset. The indicator becomes even more useful when you identify a divergence, a situation where the indicator moves in the opposite direction of the price. This is a bearish divergence. Price at the top hits a new high, but the CMF below makes a lower high. This shows the rally lacks volume. Without buying support, the price follows with a sharp downward reversal. You can also see the reverse, a bullish divergence. Here, the price is sliding to a new low, but the CMF is trending upward, creating a higher low. Even though the price is dropping, the indicator shows that institutions are taking advantage of the lower levels to buy. Identifying these divergences allows you to spot shifts in momentum before they are fully reflected in the stock price. It is important to remember that no single indicator provides a complete view of the market. Because CMF relies on historical data, it is a lagging indicator. It won't react instantly to a sudden, high-impact news event that changes the entire market landscape in a matter of seconds. CMF shows what the money is doing, but it doesn't explain the underlying reason for movement. To improve accuracy, traders pair CMF with other tools like support and resistance levels or moving averages. This combined approach helps filter out false signals during periods of sideways, choppy movement. Profitable trading means tracking the activity of the largest participants. Observing institutional volume gives you a clearer picture of trends likely to continue. Open your charting software today and add the CMF to your watch list. Pay attention to how the zero line crosses align with significant price shifts. Waiting for volume confirmation ensures you are following the momentum rather than fighting it. Subscribe to our newsletter for more weekly breakdowns of smart money signals and market trends.